Something is happening in the silver market right now that most investors have no idea about, and by the time they figure it out, it will probably be too late to act. The people who manage the largest pools of money on the planet, hedge funds, sovereign wealth funds, institutional traders, they are quietly, methodically, and aggressively positioning themselves in silver, not gold, silver. And when you understand why, you'll realize this might be the single most important financial story of the next 5 years. So stay with me, because what we're about to walk through is not speculation. Every piece of this is backed by data, confirmed by official market reports, and playing out right now in real time. If you're new to this channel, welcome to Gold and Silver Intelligence. Hit that like button right now if you want more analysis like this, and subscribe so you don't miss what's coming, because this conversation is far from over. Let's start with a number. 46.3 million ounces. That's the projected silver supply deficit for 2026 alone, according to the Silver Institute's World Silver Survey. And before you move past that number, here's what makes it extraordinary. This is the 6th consecutive year that the global silver market has produced less silver than the world needs. 6 years in a row. Every single year since 2021, the world has consumed more silver than miners could pull out of the ground. And yet, most people are sitting on the sidelines, completely unaware that this situation exists. Here's where things get interesting. That deficit isn't shrinking, it's widening. In 2025, the shortfall was 40.3 million ounces. In 2026, it's projected to hit 46.3 million ounces. That means the gap between supply and demand is actually growing larger, even as prices have already surged dramatically. And the market is filling that gap the only way it can, by draining stored inventory. By burning through the silver that was stockpiled in previous decades. Stockpiles that are, by definition, finite. Once they're gone, they're gone. And what happens to the price of a material that the world cannot stop needing when the last of the emergency reserves runs out? That question is exactly what the smart money is already answering. And the answer they're arriving at is the reason they're buying silver right now. But let's not get ahead of ourselves. To understand what's really happening, we need to go back and look at what silver actually is, because most people only understand half of it. And the half they're missing is the half that changes everything. Most people think of silver the way they think of gold. A shiny metal you buy when you don't trust the banking system. A store of value. An inflation hedge. And they're not wrong. Silver has played that role for thousands of years. But here's the part that doesn't make the headlines. More than half of all silver demand right now doesn't come from investors. It doesn't come from jewelry buyers. It doesn't come from coin collectors. It comes from factories, from engineers, from the technology that powers the modern world. Silver is the single most electrically conductive element on the periodic table. Not one of the best, the best. And that one physical fact is reshaping the entire global demand picture in ways that even professional investors are only beginning to fully grasp. Let me show you what this looks like in practice. Every electric vehicle produced today contains silver, in the switches, in the sensors, in the battery management systems, and in the charging infrastructure that has to be built alongside it. Every solar panel contains silver paste applied to the photovoltaic cells to help convert sunlight into electricity. Every artificial intelligence data center, and there are thousands being built right now around the world, requires silver in its circuit boards, connectors, and cooling systems. Every smartphone, every 5G tower, every medical device. Silver is woven into the fabric of the modern technological economy in a way that no substitute has been able to replace, because no other material does what silver does at the same price point and performance level. And this is where the story gets much bigger than most people realize. In 2014, just over a decade ago, the solar energy sector accounted for roughly 11% of total global silver demand. By 2024, that number had risen to 29%. In 1 decade, solar alone went from a minor footnote in the silver market to nearly 1/3 of everything the world needs. And global solar installations are still rising. The world is still building. The energy transition is still accelerating. The demand that drove silver consumption to record highs isn't going away. If anything, new sectors are lining up to take the baton. Now here's the detail most people miss. Mining silver is not like printing money. You cannot simply decide to mine more silver and have more silver appear tomorrow. About 70% of silver produced globally is a byproduct of mining other metals: copper, zinc, lead. That means silver supply is largely determined by demand for those other metals, not by demand for silver itself. There is no switch you can flip. There is no dial you can turn up. When demand for silver spikes, the supply side has almost no ability to respond quickly. The pipeline of new mines takes years, sometimes a decade, to develop, permit, and bring online. And in the meantime, declining ore grades at existing mines mean that even maximum effort produces diminishing returns. The Silver Institute and Metals Focus, the leading precious metals research consultancy, have both confirmed that structural constraints in mine supply are expected to continue limiting growth for the foreseeable future. That alone would be a significant story. But something else happened. In 2025, silver didn't just attract industrial buyers, it attracted investors on a scale not seen in years. The same macroeconomic forces that had been building for years, persistent inflation, rising government debt across major economies, geopolitical instability, questions about Federal Reserve independence, all of those forces converged at once. Western investors, who had been largely absent from the silver market for several weak years, came flooding back. Global physical silver investment is now forecast to increase by approximately 20% in 2026, reaching a 3-year high. And that surge in investment demand is hitting a market that was already running on empty from the industrial side. What happened next in early 2026 gave us a preview of what's coming. When institutional money began pulling physical silver into CME vaults and exchange-traded products simultaneously, the physical supply chain for refiners and manufacturers began to fracture. Premiums on physical silver bars jumped. Product shortages became common. A liquidity squeeze took hold in October 2025, and the pressure spilled into early 2026. On January 29, 2026, silver hit an all-time high above $121 per ounce. That's not a rumor, that's a fact. And it happened because the collision between surging investment demand and a structurally undersupplied market produced a price spike that the mainstream financial media still hasn't fully explained to its audience. Here's where the situation becomes much bigger. Sprott Asset Management, one of the most respected names in precious metals investing, has been publicly flagging something significant. We are starting to see meaningful institutional inflows into silver at a global level. That matters because institutional money moves slowly. It doesn't chase price. It front-runs fundamentals. When institutional investors are moving into an asset, it's because their analysts have looked at the supply and demand picture and concluded that prices have not yet caught up with the underlying reality. They are buying the story before it becomes the headline. And what story are they reading? They're reading the same data we're walking through right now, a 6th consecutive year of deficit, a supply chain that cannot expand fast enough, an industrial demand profile that ties silver to some of the most unstoppable technological trends on the planet, electrification, artificial intelligence, renewable energy, and an investment demand cycle that is just beginning to accelerate. But that is only part of the story. Let's talk about China. Because this is a piece of the puzzle that almost nobody in the Western financial media is discussing. In January 2026, China tightened its silver export licensing regime. On the surface, that sounds like a bureaucratic policy change, but consider what it means in practice. China is one of the world's largest silver producers and consumers. When China restricts silver exports, it is effectively keeping more silver inside its own borders. It is choosing to prioritize domestic access to a metal it clearly considers strategically important. That restriction further tightens an already constrained global physical market, and it signals that at the highest levels of Chinese government and industry, silver is being treated as a critical material, not a commodity to be exported freely. That is the kind of signal that smart money pays very close attention to. Now, I want to address something directly, because intellectual honesty matters on this channel. The silver story is not without risk. After surging more than 147% in 2025, prices pulled back significantly from that January 2026 high, above $121. Analysts at Heraeus cautioned in their 2026 outlook that the rally took prices higher, faster than fundamentals could sustain in the short term. Big banks and institutions, as Kitco News reported, have grown cautious with silver as it approached $80 per ounce. Some forecasters see a period of consolidation before the next major leg higher. JP Morgan projects silver averaging around $81 per ounce for 2026, which, even at that level, represents dramatic appreciation from where silver was sitting just 2 years ago. These are not base cases for failure. They are the conservative end of a range of forecasts that includes Bank of America flagging a bull scenario of $135 to $309 per ounce if physical shortages intensify. What does that range tell you? It tells you that even the most conservative professional analysis sees silver materially higher from here, and the most aggressive scenarios based on genuine institutional modeling describe a silver price move that would be one of the most significant commodity repricing events in modern financial history. Before I tell you what the smart money's longer-term thesis looks like, and where the price could go if the deficit picture doesn't resolve, I want to hear from you. Drop a comment right now. Tell me this: do you currently own silver? And if not, what's holding you back? Your answers tell us exactly what topics to go deeper on next. Now let's talk about the gold to silver ratio, because this is the metric that institutional precious metals analysts watch most closely. And right now, it's telling an important story. In April 2025, the gold to silver ratio hit 105 to 1. That means it took 105 ounces of silver to buy a single ounce of gold. Historically, that ratio has averaged somewhere around 70 to 1. A reading of 105 was a screaming signal that silver was deeply, historically undervalued relative to gold. Professional money managers who understand precious metals cycles have seen this pattern before. Every time the ratio stretches to extremes, silver eventually snaps back, and when it does, it tends to dramatically outperform gold in percentage terms. And that's exactly what happened. By early 2026, the ratio had compressed to approximately 57 to 63 to 1 as silver's dramatic outperformance played out. Silver went from deeply undervalued to more fairly priced relative to gold. But here's the critical question. Is the move over? Has silver already priced in everything that's coming? And the answer, when you look at the structural supply and demand picture, is almost certainly no. Here's why. The deficit is not a one-year story. It's not even a two-year story. According to the Silver Institute, this deficit cycle has been running since 2021, and the structural factors driving it, declining ore grades, constrained mine expansion timelines, relentless industrial demand from electrification and AI, and now a resurgent investment demand cycle. None of those factors are reversing in the near term. The world is not building fewer data centers. It is not deploying fewer electric vehicles. The energy transition is not being canceled, and the miners cannot conjure new silver supply in a time frame that would meaningfully close the gap. What this means is that the smart money isn't just making a trade. They're making a multi-year structural bet. They're positioning for a scenario in which the physical silver available to markets continues to tighten, in which the inventory drawdowns that have been quietly filling the deficit gap eventually reach a breaking point, and in which the price must, not might, must, rise to levels that begin to incentivize the kind of new supply investment that takes years to bear fruit. When you step back and look at the full picture, something becomes clear that most individual investors never see, because they're looking at silver one headline at a time. This is not a story about a metal getting popular. This is a story about a permanent collision between a world that needs more and more silver, for the technology that is not optional, for the energy transition that entire governments have committed to, for the electrical infrastructure that AI and electrification demand, and a supply chain that has fundamental, structural limits on how fast it can grow. It's a story about a market that has been running at a deficit for 6 straight years, draining reserves, and is now starting to attract the kind of institutional investment capital that tends to accelerate price moves that were already inevitable. And here's the final thing I want to leave you with, because this is the part that most people never connect. Silver surged more than 147% in 2025. That sounds like a lot, and it is. But consider this. At the beginning of 2025, silver was sitting around $30 per ounce. At its all-time high in January 2026, it reached $121. And even after that surge, even after the most dramatic year in recent memory for this metal, the world still doesn't have enough of it. The deficit is still widening. The supply constraints are still structural. The industrial demand base is still growing into entirely new technology sectors. Investment demand is forecast to hit a 3-year high in 2026. Silver went from $30 to $121, and the fundamental case got stronger, not weaker. That is why smart money is buying silver right now. Not because they chased the move, not because they caught the news cycle, but because they read the data, modeled the deficit, mapped the demand trends, understood the supply constraints, and concluded that the repricing of silver, the real repricing, the one that fully reflects what this market actually looks like, has not yet happened. The question isn't whether silver matters. The data has answered that. The question is whether you're going to be sitting on the sidelines when the next chapter of this story gets written. What do you think? Is silver the most underappreciated asset in the market right now? Or are there risks we haven't fully accounted for? Tell me in the comments. This community is sharp, and I genuinely want to hear where you're positioning. If this analysis gave you something to think about, please hit the like button. It takes 2 seconds and it helps us reach more people who need to see this information. Share this video with someone you think should understand what's happening in the silver market right now. And if you haven't subscribed to Gold and Silver Intelligence yet, now is the time. We cover precious metals, macroeconomics, and the moves that institutional money is making before the mainstream catches on. Subscribe and turn on notifications so you never miss it. The smart money is already moving. The only question left is whether you're watching from the sidelines or paying attention.